Hello everybody, it's FCT's full year 22 numbers. For this set of numbers, I thought there were, in conclusion, 3 pluses and 1 minus. So let's get into it. And this is the share price performance. And you can see the sell-off over here, right, in October. Man, I thought September was bad, but October was a complete bloodbath, right? I talked about it in another video, so I'll put the link over here. It was a bloodbath, but it was also very fun. Unfortunately, I didn't really buy anything for FCT during this sell-off, because there was really a whole bunch of REITs going on heavily discounted prices, right? So I went on a bit of a shopping spree in September, and in October I really piled in my bullets. So I'll put the video as to what I bought recently over here, and go check it out. For FCT, I would have loved to buy it if I have more capital, but I didn't, and I have to spend the bullets elsewhere. But look at the valuations. The sell-off over here was quite brutal, but it wasn't that bad. I thought in general FCT has held up pretty well compared to other REITs. Some of which has fallen like 20+%, 25% year to date, right? These are the numbers for the DPU, and I was hoping we can see a 12.5 print, but it was not to be. It was 12.2 for the full year only. So if you look at the NPI yield, so you get the NPI and divide it by the gross revenue. Last year it was 72.1, and this year it was 72.5. So actually it's not bad. I thought the NPI yield would have gone down with higher expenses, given the inflationary environment we are seeing in, right? But they seem to have managed it pretty well though. But I think overall the top line growth was also impacted by the expenses, and of course interest costs, right? And look at the valuations actually ticked up, which was quite nice to see. So we went from 2.3 to 2.33 in terms of NAV. And I think this was important because in this environment, you really don't want a case where the cap rates expand and then the asset values drop and then the gearing goes up and then you get up in a whole bunch of trouble, right? So you can see that the valuations actually held quite well on a year-to-year basis. The cap rates were exactly the same if you compare this column with this column, right? So the valuers are taking a quite a constructive view of suburban malls in Singapore. So overall, the assets went up, but mainly because of the increased rental, right? So that's good news. NAV is still rock solid. So this is the minus part, right? You can see the numbers are actually quite nice. The leverage is 33%, which is one of the lowest in the S-REIT space, right? ICR is 5 times, decently well hedged. Because of that 2.5%. But I think this column, this box over here is where the minus is. So you can see a lot of the debt is going to expire over the next 3 years. So in FY23, there's 21.5%, 24 is 26%, 25 is 28%. So for the next 2 years, you're going to see that like 21.5 plus 26. So something like 48% going to expire, right? So when they refi this stuff, there's going to be an increase in the financing cost. And if the Fed really goes berserk and hold rates for the next 3 years until 2025, then the impact will also get increase because in 25 to 28% are expiring, right? So the profile of the debt expiries is not really that positive in view of the Fed rate hikes path, but the Fed can also kind of cut, right? Or it may hold only until 24, right? So it's hard to say because it all depends on the inflation. But I think this is the minus part for this REIT though. The near-term expiries of the debt and the uncertainty over the Fed rate hike paths. So that's going to have an impact on the financing cost, therefore the DPU. But I think the if you think at this number, all-in cost is going to go from 2.5% to something like 3% by next year, and maybe over 3.5% by end of 23. So then I think the impact of the DPU should be like 5 to 10%, right? So they don't give any sensitivity analysis, so it's quite difficult to say. And we also don't know how much of their fixed debt will roll off here, or here. So they didn't really give more details, so it's quite difficult to give a quantitative analysis. But this is the main negative for this REIT. So let's talk about the 3 positives that I see. First of all, this is the occupancy cost, right? So this is the ratio of the rental by the tenants to their turnover. So if you look at the occupancy cost for the tenants in 22, this is the lowest compared to the past 5 years, right? So we're probably back to 2016 to 2017 levels, right? This suggests to me that they have actually quite a lot of room to drive up their rentals, because the tenants, given their strength of their retail sales, should be able to withstand a higher rental. So probably to bring up this number to like 16.5 to 17%, right? So I think these numbers suggest to me that there's room to raise their rents if they're willing to do it. Of course, it depends on the market conditions, but it suggests to me that it's possible. And so this is the level number one, right? Raise rents. It also suggests to me that they have the option to raise their service charges, so to offset the inflationary expenses for utilities and labor and stuff. So I think this is the most important level. And if you look at the coverage of the suburban retail assets, FCT is like 10%, right, of the total stockpile, and this is the number that's garnered from the annual report last year, right? So CICT has 11%, FCT has 10%, NTUC had 9%. But of course, NTUC is gonna put up this stuff for sale, right? So it depends to see who's gonna get it. Land lease at 7%. But I know like all these guys pretty much have debt as well, right? So if that cost is gonna increase for everybody, then I suggest that then it would suggest to me that everybody will have to do pretty much the same thing, which is to raise their rents, right? Because it cannot be a case that the landlords get the interest rates rising and impacting their costs, but yet they don't pass through some of these pressures, right? So it would suggest to me that there's actually room for them to raise rentals. So you have to see what happens coming forth. But look at the rental reversions for this year. It's pretty healthy, right? On the portfolio basis, it's like a 4% average rental reversion, right? So I think there's room to push this number higher as well, depending on the market condition and the normalization of the economy as well. So look at the occupancy for the portfolio, pretty healthy, right? Strong 90%, all over the place. Maybe a bit of a weakness in the CCP and Century Square, but it's kind of recovering. I think another level that could play is for asset reshuffling, right? Especially this fellow over here. So this is an office asset in Central Plaza, right? This is in Tiong Bahru. So I think what can happen is that this year they acquired 10% in Waterway Point. So there's always an option for them to do a asset reshuffling, right? So sell this fella an office asset and then buy more of Waterway Point, right? So if you look at the yield spreads, right? Offices tend to trade like 3+% yield, right? And then you can buy the Waterway Point at like 4+% yield. Then that's a yield pickup, right? So this is always an option they have to do a bit of asset shuffling. I think level number 3 will just be atrium sales, right? For the past 2 years, we have seen a complete absence of atrium sales, right? So if you go to the shopping malls, you can see that the atriums are all empty because of the safe management measures due to COVID and don't allow crowds at the atrium. But going forward with the relaxation of the safe management measures, atrium sales will be a big comeback going forward. Actually, if you go to the malls right now, you can see the atrium sales coming in already, right? For the mid-autumn, you can see the mooncake festivals, and you can see, well, all over the place, right? There are carnivals and play fairs in the malls already. And next year there'll be CNY, and then there'll be Christmas and stuff. So you have the absence of atrium sales for the past 2 years, and now you can have it for next 2 years, right? So other than just hiking rents, asset reshuffling, you also have organic growth in terms of this lost income stream that they did not have in the past few years. So I think this is the short coverage of the FCT numbers. Still pretty solid read. I like it a lot. I have quite a fair bit in my portfolio actually. So hoping for good results for the next set of numbers.